You miss one direct debit. Maybe your energy bill bounced because payday landed awkwardly. It happens to millions of people every month. But what happens next isn't what you think. Because while you're worrying about a £35 late payment fee, your bank has already started a process that can leave a mark on your credit file for the next 6 years. And the people making decisions about your financial future aren't the ones you've been paying your mortgage to for the last decade. They are algorithms, outsourced call centers, and debt collection agencies who bought your account for pennies on the pound. I've spent 3 weeks investigating exactly what happens inside UK banks when you miss a household payment. What I found explains why some people bounce back within months while others spiral into problems that cost them their homes. Let's start with what actually triggers the system. When your direct debit fails, your bank does not immediately panic. Most current account terms give you until the end of the business day to get funds into your account. If the money appears, the bank will often retry the payment automatically. No harm done. But if the payment genuinely fails, several things happen simultaneously. Your bank records the failed payment on their internal system. Your creditor, whether that is your energy company, council tax office, or mortgage lender, gets notified that funds were not available. And depending on who you owe money to, a clock starts ticking. Here's where it gets interesting. Different creditors have completely different timelines for what happens next. Your council tax office operates on a much faster escalation than your credit card company. Miss 2 council tax payments and most local authorities will send you a court summons within weeks. Miss 2 credit card payments and you will get strongly worded letters for months. The variation is not random. It comes down to one thing: how easy it is for each creditor to eventually force you to pay. Council tax is backed by magistrates' court powers. Councils can send bailiffs, take money directly from your wages, even send you to prison in extreme cases. Credit card companies have none of those powers. They have to go through the county court system, which takes longer and costs them money. So councils move fast and credit card companies move slowly. Your bank knows this. Their internal systems categorize your missed payments accordingly. Now here is something most people do not realize. Your bank's internal risk scoring updates the moment you miss a payment with them. It goes further than that. Most major UK banks subscribe to credit data sharing arrangements that update frequently, sometimes daily, sometimes even faster for certain products. So if your mortgage payment bounces on Monday morning, your bank's own systems flag you as higher risk immediately. Within a day or two, that missed payment often shows up across their credit data feeds, affecting how they view your other accounts. I spoke to a former risk analyst at one of the Big Four banks who explained it to me this way. Every current account holder has an internal score that updates constantly. Miss a mortgage payment and your score drops. Miss a second payment and it drops further. Cross certain thresholds and automatic processes kick in. These processes can include reducing your overdraft limit, declining applications for credit card limit increases, or flagging your account for what banks internally call enhanced monitoring. That's where software starts analyzing your spending patterns more closely, looking for signs of financial distress. The signs they look for include increased gambling transactions, reduced grocery spending, and new direct debits to short-term lenders. If the algorithm spots these patterns alongside missed payments, your file gets escalated to a human for review. Let me tell you about what happens when a mortgage payment goes unpaid. Mortgages are treated differently to almost every other form of credit because they are secured against your home. This means lenders have serious powers but also serious obligations. Under Financial Conduct Authority rules, mortgage lenders must treat customers fairly and explore every possible option before repossession. In practice, this means they are required to contact you, discuss your circumstances, and offer forbearance where appropriate. After one missed payment, you will typically receive a letter asking you to get in touch. After 2 missed payments, the calls start. After 3 missed payments, you will receive what is called a formal arrears notice, which legally must set out exactly how much you owe and what options are available. But here is what the official process does not tell you. While your lender is sending you sympathetic letters about discussing your options, their internal systems are simultaneously preparing for the possibility you will not recover. At most major lenders, accounts that are 3 months in arrears get automatically referred to what is called the pre-litigation team. These are not the friendly advisors you speak to on the phone. They are specialists whose job is to assess whether pursuing court action will recover more money than selling your debt would. This is a pure mathematical calculation. If you owe £200,000 and your home is worth £250,000, they will pursue repossession because they will get their money back plus interest. If you owe more than the property is worth, they might sell the debt to a specialist investor instead. Either way, decisions about your home are being made by people you have never spoken to, based on spreadsheets you will never see. The debt sale industry in the UK handles billions of pounds worth of accounts every year. Understanding how it works explains a lot about why dealing with missed payments can feel so frustrating. When a bank decides your account is unlikely to recover through normal collection, it has 2 options. It can continue trying to collect, which costs money in staff time and resources, or it can sell the debt to a specialist purchaser and take an immediate cash payment. Most consumer debts sell for somewhere between 5 and 15 pence per pound owed according to industry estimates. So if you owe £10,000 on credit cards, a debt purchaser might pay between £500 and £1,500 to buy that debt from your bank. Once the sale happens, your bank is out of the picture entirely. The debt purchaser now owns your account and all the rights that come with it. The purchaser can pursue you through the courts, add its own fees and charges, and report to credit agencies under its own name. This is why some people find themselves being chased by companies they have never heard of for debts they thought were with their bank. The original creditor decided you were not worth the effort, and it sold you on. The debt purchaser's entire business model relies on collecting more than they paid. If they bought your £10,000 of debt for £1,000, they only need to recover 11% to break even. Anything above that is profit. This changes the negotiation dynamic completely. Your original bank might have accepted 50% of what you owed as a settlement. The debt purchaser might accept 30% because that is still 3 times what they paid for your account. So what actually protects you during this process? There are 3 lines of defense most people never use. The first protection is something called breathing space. Introduced in 2021, breathing space gives people in problem debt 60 days during which creditors cannot add interest, charges, or take enforcement action. You apply through a debt advisor, not directly, and it can only be used once. The second protection involves the financial ombudsman. If you believe a creditor has treated you unfairly during the collections process, complain to the creditor first. And if that does not resolve the problem, escalate the complaint to the financial ombudsman. Banks take ombudsman complaints seriously because losing a case costs them around £750 in case fees, plus any compensation awarded. The third protection is the court system itself. Even if a creditor obtains a county court judgment against you, you still have options. You can apply for a payment plan based on what you can actually afford. You can apply to have the judgment set aside if you never received the original court papers. And if bailiffs are involved, there are strict rules about what they can and cannot take. The problem is that none of these protections work if you do not engage. The banks know that a significant percentage of people in financial difficulty simply stop opening letters. Here is what genuinely surprises most people I have spoken to about this topic. Banks actually lose money on aggressive collections. A report from the Money and Mental Health Policy Institute found that customers who receive supportive forbearance are significantly more likely to return to full payments than those who receive threatening letters and constant phone calls. Yet most banks still default to pressure tactics in the early stages of arrears. Why? It comes down to volume and automation. When you are handling millions of accounts, personalized support is expensive. Automated letters and calls are cheap. Even if gentle approaches work better on average, the cost of implementing them across every account in arrears does not make financial sense for the bank. This creates a strange situation. Banks know that vulnerable customers need support, not pressure. Their own research tells them this. But their systems are built around processes that apply the same escalating pressure to everyone, regardless of circumstances. The FCA has repeatedly criticized this approach. In their 2023 review of consumer credit firms, they found widespread examples of firms failing to recognize signs of vulnerability and continuing collection activity that made situations worse rather than better. Let me leave you with something practical. If you're struggling with household payments right now, the single most important thing you can do is communicate before things escalate. Call your creditors before you miss payments, not after. Almost every major lender has hardship teams who can pause payments, reduce interest, or restructure what you owe. The second thing is to understand priority debts. Council tax, mortgage, rent, energy, and water are all priority debts because non-payment leads to serious consequences like eviction or prosecution. Credit cards, loans, and catalogs are non-priority because the worst outcome is a court judgment and damage to your credit score. If money is tight, pay priority debts first. Always. I want to know if you have dealt with any of this yourself. Have you had to negotiate with a lender when payments got difficult? Did they treat you fairly, or did you feel like just another number? Drop your experience in the comments because I think we can all learn from each other on this one. If you found this useful, subscribe to the channel. I am investigating how energy companies are using your smart meter data next, and it connects directly to what we have talked about today. The same automation that decides how banks treat you when you are struggling is now watching your energy usage in ways you probably have not thought about.